have to start with the inflation. Running super hot, the RBA's pressing pause on the hikes for a little bit, but do you think that they can afford to keep doing so, or is that the risk to the housing market that severe that they might stay their hand a little bit longer?
Yeah, you're right. They've pumped it too high. I think the call when it came out, no hikes till 2024, that rings in everyone's ears. That was the start of things going a bit too pear-shaped, and it's really hard to unwind it now. We all know that there is a decent rollover coming in Q2 from fixed to variable. That's going to put a substantial pressure on consumer spending. I think consumer spending struggles through 2023. It's not just in Australia, it's happening globally. And property market is rolling over globally. Australia is highly leveraged for the right reasons, because we give tax benefits, we give a lot of handouts to boost the property sector. And RBA basically took it too far, and I think it's going to unwind.
But to extend your thesis then to what your expectations are for the Australian equity market, if all of this does take place, if you do see consumers rolling over because of hundreds and hundreds and hundreds of billions of dollars that are shifting over in terms of the mortgages and the impact that will have on the wealth effect and everything else, is where we are right now for the ASX, is that at risk? And if so, how deep do you think it's going to go down?
Yeah, that's an interesting one. Let's just look at the big caps. The two biggest stocks are BHP and CBA. BHP is up on China optimism. None of the commodities that BHP is involved in are trading anywhere near all-time high, except BHP is trading at all-time high. BHP is over 10% of the index. So if you strip out BHP by itself from our index is not doing as well as it did before. Now, then you look at the number two stock, and that's BHP is purely on the China optimism, which I think is way overplayed. Then you look at the second one is CBA. It always attracts a higher multiple. It's paying basically a yield that's less than or close to US 10-year bond yield. So you're saying that it's better than the US economy. And it's basically leveraged to the property market. So we all know the property market is weak. And we know the bond yields are coming off. And we know that all the banks have written down their bad debt provision. So we're likely to see that reverse. Profits are going to start to slide. They've been attacked by fintechs on all the high margin plays, and the banks are struggling, except CBA is pretty close to the highs where it's been pretty much trading sideways for the last 18 months. So that just tells you where our market is, mainly because of global fund flow. So the whole of January, we've seen money come out of US and chase Asian exposure, especially China for the reopening, and Australia has benefited from that cycle. So our market was expensive. Now it's gone even more expensive. So I think the downside risk is pretty high.